Hey everyone, it's Angel here at The Viral Investor. Today we're breaking down a major new agreement between Pfizer and US drug pricing. The deal promises deep discounts on current medications and new cost standards for future ones. Is this the long-awaited solution to soaring healthcare costs? Or does it destabilize the profit engine of pharmaceutical innovation? This policy shift matters directly to you because of the growth of drug spending throughout the United States. The increase in drug pricing is one of the fastest and biggest increasing areas of healthcare spending. This agreement could raise your retirement budget or introduce new volatility to your healthcare-focused investments. In this video, we'll break down the immediate discounts, the long-term pricing framework, and the massive domestic investment commitment, giving you a clear view of both the optimistic and pessimistic scenarios. Stick around. We'll get to the bottom of whether the deal is truly protecting medical advances for the future, while at the same time securing the prices Americans want today. So can Americans really expect prescription drug prices to drop by 50% or even go free without crashing the system?
In addition, Pfizer is agreeing to provide some of their most popular current medications to all consumers at heavily discounted prices of anywhere between 50 and even 100%, and that's off the price. And in some cases, even more than that. These drugs will be available for direct purchase online at a website operated by the federal government.
On the bright side, this could finally break the chain of middlemen that inflate drug prices. Direct access means lower costs for consumers and possibly higher sale volumes for Pfizer. It could also ease political pressure on both the company and the administration. But there's a catch. When the federal government runs a sales platform, it changes market dynamics. Smaller pharmacies could lose customers, and heavy discounts could squeeze out competitors who can't afford to match those prices. For everyday Americans, that might mean cheaper medicine soon, but fewer independent options over time. If we start paying what other nations pay for drugs, will it really fix the pricing problem?
We're also announcing that moving forward, all new medications introduced by Pfizer to the American market will be sold at the reduced most favored nation cost. So we'll be paying essentially what other countries are paying, who have been much lower for many, many years.
Here's the upside. This could make the US drug market fairer. If prices align with Europe or Canada, Americans could see savings of 30 to 60% on brand name prescriptions. Medicare could also save billions annually. Still, we can't ignore that foreign countries control prices through negotiation or regulation, not free market dynamics. If those same methods spread here, drug companies could scale back US research, spending, or slow new product launches. Cheaper drugs could help your wallet today, but your long-term access to advanced treatments might shrink. What happens when a global giant spends $70 billion to move production back home?
Furthermore, Pfizer will invest $70 billion to reshore domestic manufacturing facilities. In other words, they're going to bring a lot of their facilities to make their drugs and make what they make, their product. They're going to make it in the United States. I appreciate that $70 billion investment and fund research and development right here in America.
If this works as intended, it could create thousands of high-skilled jobs and secure the nation's drug supply chain. Local manufacturing also cuts reliance on China and India, reducing geopolitical risks, something investors increasingly care about. But domestic production is far more expensive. Labor, compliance, and energy costs could eventually raise drug prices again, undoing some of the initial savings. For consumers, that could mean more reliable access, but maybe not cheaper pills in the long run. Can one move really end global price gouging, or is that just political theater?
But by taking this bold step, we're ending the era of global price gouging at the expense of American families. And
on the bright side, this statement sends a clear message. The era of overcharging Americans may be coming to a close. Consumers will feel immediate relief, especially seniors and low-income families. On the flip side, labeling global pricing as gouging could oversimplify the issue. Different healthcare systems have different cost structures, and this shift might discourage US companies from funding risky R&D ventures. Short-term fairness might come at the cost of long-term medical progress. Are Americans still paying to fund the world's drug research?
And I want to just ask Secretary Kennedy to come up and we'll start and we'll go through it with Oz and Klopp and Bourla and McCary.
Why are we spending more on this country than any other country? Why are we spending 75% of the revenues that come to the pharmaceutical industry? We're doing all the research and everybody else is riding on our slipstream. Americans should not be gouged paying 300 or 400 or 1,000% more than people in other countries for the exact same drug many times manufactured in the same factory in New Jersey and sold in Great Britain for 1/10 the price that it's being sold for here.
If the US pays fairer prices, other nations may start sharing more of the research burden. That could make the global system more balanced and sustainable. But research funding has to come from somewhere. If the US contribution drops, the pace of new drug discovery could slow worldwide, a bad sign for long-term investors in biotech and healthcare. Your prescriptions might cost less, but so might the global supply of medical breakthroughs. Can policymakers really keep drugs affordable without stopping innovation?
We began to deal with the fundamental challenges we have, which is protecting medical advances for the future while at the same time securing the prices Americans want today. We're going to continue to stimulate and strengthen innovation.
Here's the upside. If companies like Pfizer balance lower pricing with smarter R&D investments, we could get the best of both worlds, affordable care and steady innovation. But there's a catch. Cost controls rarely leave innovation untouched. Lower margins could slow research and drive capital away from early-stage biotech firms. That could mean cheaper drugs today, but fewer cures tomorrow. How much does fairness really matter in drug pricing if it slows medical progress?
And all great deals, and this is a great deal, are rooted in principles. And this deal was rooted in the principle of fairness. Now, the president could have directed us to go to the poorest country on the planet and find the cheapest price for every single drug and bring that back to the United States and use the might of the government to insist that that's the price we pay. And that might have worked, actually, for just a little bit. But very quickly, it would have utterly destroyed innovation in pharmaceuticals. It would have destroyed American primacy in building life-saving medications. There are nearly 20,000 known diseases on the planet. We have treatments or cures for far fewer than 10% of them.
Fairness in pricing can rebuild public trust and make essential drugs accessible for millions who struggle with high costs. That's good for both consumers and political stability. Still, we can't ignore that the speaker could be right. Slashing prices too aggressively would cut R&D spending and slow discovery across the industry. For consumers, this balance between fairness and innovation could shape healthcare for decades to come. What exactly is a most favored nation price, and could it backfire?
First, let's start with the definition of MFN. What do we mean by that? This is not made-up list prices that have often been quoted in prior administrations, stuffed with fees and rebates. We're talking about we start at net prices, after fees, after rebates, the prices people actually pay here, the prices people actually pay in other wealthy countries. We then index to a basket of countries, wealthy countries, across the world. And we go drug by drug, and we look for the lowest price, and that becomes the starting point.
If executed well, MFN pricing could remove the games around rebates and bring real transparency to drug costs. Investors could see cleaner pricing models and steadier margins in the long term. But on the flip side, if every country starts racing to the bottom, innovation could stall, and availability of certain drugs could drop. Consumers might save at the counter, but shortages could appear if suppliers can't profit. How do tariffs and pricing uncertainty shape pharma investing?
In our industry, we had two major overhangs that have substantially reduced our valuations and create concerns for us in our ability to invest. We are addressing both of them right now, and I will speak about them. The first one was the uncertainty of tariffs. Because President is absolutely right. Tariffs is the most powerful tool to motivate behaviors, Mr. President, and clearly motivated ours, right? By this agreement that we did, we commit to onshore the production of our medicines that are consumed in the US and are made outside the US. The second overhang in our industry was this uncertainty. What will happen with the framework of pricing in the country?
On the bright side, clarity reduces risk. If tariffs stabilize and pricing becomes predictable, investors might finally get consistent valuations in the pharma space. But there's a catch. Both tariffs and pricing policy can shift fast under political pressure. One policy change could wipe out billions of dollars in market value overnight. Consumers might not feel it directly, but their 401k could. Is this the real key to lowering healthcare spending in America?
The growth of drug spending, that is, the increase in drug pricing, is the fastest and biggest increasing area of healthcare spending. So today's announcement has incredible implications for healthcare spending in the United States.
Here's the upside. Slowing drug price growth could be a huge relief for public budgets and private insurers. That's a win for taxpayers and markets alike. Still, we can't ignore that lower prices today might lead to fewer cost-saving treatments in the future, especially those that replace expensive surgeries or hospital stays. You might save on prescriptions, but lose access to breakthroughs that could have saved more money in the long term. How much is speed worth in the drug approval game?
A voucher to get a review in weeks has a market street value of about $500 million because every day is money when it comes to getting a drug approved.
Here's the upside. Faster reviews means drugs reach patients sooner, and companies earn revenue faster. That's good for investors and could boost competitiveness. But the risk is that speed could sacrifice scrutiny. If rushed approvals lead to safety issues, lawsuits or recalls could follow. Faster access sounds great, as long as quality control doesn't get left behind. Finally, what does this all mean for retirees and taxpayers?
In terms of pricing, it's going to be great for Medicare, Medicaid, Social Security. It's going to be great for everything because your medicine costs are coming way down. We have some examples that I think we'll be able to show you next week of over 1,000% in some cases, where a pill that cost $10 in London was costing $130 in New York and various other places within the United States. And the same thing with Canada. People would go to Canada, they go to Mexico, they'd go to other places to buy drugs. They don't have to do that anymore.
If this plan holds, retirees could see massive savings through Medicare and lower copays. It could also reduce U.S. healthcare spending overall, but those savings depend on profit margins holding up. If they don't, the government may need subsidies to keep the system stable. For older Americans, this could be a direct financial win, at least for now. What do you think? Is this a win for consumers or a risky move for the market? Let me know in the comments below. Okay, to recap, here are the key takeaways from the Pfizer drug pricing agreement. This agreement aims to provide significant immediate relief to customers through discounts and to secure a lower, fairer price on new medications through the most favored nation framework. That is the bullish outlook for your household budget, as it addresses the fastest and biggest increasing area of healthcare spending. The bearish perspective is that by sharply limiting the historically high profits earned in the US market, the industry's ability to fund high-risk research for the future is put into question, potentially stifling innovation. The $70 billion domestic investment is a clear win for jobs and supply chain security, but it is tied to an unsettled and uncertain pricing framework. If you found this analysis helpful, please like this video and subscribe to The Viral Investor for more breakdowns of the headlines that affect your money. And which matters more to you, short-term savings or long-term innovation? Let me know in the comments. And stick around. In the next video, we'll take another viral headline and break down what it really means for your money, your investments, and your future. Thanks for watching, and I'll see you in my next video.